So hi guys, it's SJ speaking, and in today's video, we're going to see about the basic share market terminologies and jargons. So jargons means the confusing terms for a normal person who doesn't know about a specific subject. For example, if I come and say to you, you don't know nothing about trading, and I come to say to you some technical term regarding trading, and you can't understand it. So this is known as jargons. So for the person who doesn't know a little. Nothing about trading, so this is the video for them. So this is for the beginners, the trading, those who are interested in trading but know nothing about trading, so this is a video for them. So let's see what are the basic terminologies for the beginners. So first thing is equity. What is equity? Equity means shares. So it refers to the amount of shares owned in a specific company. Suppose if you are buying a share of the company, you own equity of the company. So this is what it denotes. This is what equity is. So trading can be done in that is shares, or you can also use in derivatives. You can also trade in derivatives markets such as options and futures. But these shares are known as equity. So it is also known as cash market or equity. So if you are trading in stocks, so that is it. So the next thing is bid price. Bid price, ask price. So or it is also known as offer price. So what is the bid price? Suppose if you are going to a shop and you are buying something from that shop, then you are saying that this is the highest price that I'm willing to pay for that thing. So that is known as your bid price. So in case of stocks, the highest price that the buyer is willing to pay of a stock is known as its bid price. What is the ask or offer price? The lowest price that the seller is willing to sell a stock is known as ask price. So the difference between the bid and ask price is known as spread. So for example, if you are buying at 95 rupees, the seller might be giving at 95.5. So this 0.5 is the spread. So this spread is sometimes taken by brokers as commission. For example, in some forex brokers, they take the commission in form of spreads. So usually the ask price is always a little bit higher than the bid price. Then what is the slippage? The slippage refers to the difference between the expected price at which the trade is placed and the actual price at which the trade is executed. What is meant by this is because if you didn't see my types of orders in share market videos, watch that, then you can really understand this. So there are two types of orders. One is market order, another is limit order. Market order usually buys the price at the best available price. That is, best price for the buyer means it's the lowest asking price. The lowest price that the seller is willing to sell, it is the best price for the buyer. So market price buys at that price. Whereas limit price, you can specify the price that you want to buy, and when once the stock prices reaches the specific price, your stocks get purchased. So this is the difference between market and limit price. So slippage occurs when you are placing market orders. For example, if you are expecting the stock is trading at 95 rupees, you are expecting the stock to be purchased at 95 or 95.5 or 96 rupees. But due to over volatility of the market, volatility means over fluctuation of the market, there is excessive demand and the stock suddenly went to 100, and you have you gave order at when it is trading at 95, but it only got executed at 100 rupees. Since there are no sellers in between, the next seller was only at the next lowest asking price was only at 100 rupees. So this is the slippage. You got around 4 rupees of slippage. Even if you are thinking at 96 rupees, it will be executed. It executing at 100 rupees. So 4 rupees is slippage. So there might be some losses occurring due to this. Is because you are buying at a higher price. You are expecting to be bought at the lower price, but since it is at higher price, this is known as slippage. So when this slippage occurs due to external market conditions. So overall market conditions, it is known as slippage. When it occurs due to your own trades, for example, if you are buying bulk, if you are buying around 1 lakh shares, you are having huge amounts of money and you are buying around 1 lakh equity shares of a specific company. All the 1 lakh shares don't get purchased at 95 rupees. Some might get at 96, some might get at 97, some might get purchased at 98. So so this is known as impact cost. In this case, it is known as impact cost. So this occurs due to our own trades, your own purchasing of the trades. It occurs So purchasing of shares it occurs, it is known as impact rate. If it occurs due to the external market conditions, it is known as slippage. So this is the difference between impact cost and slippage. So exchange refers to the place or an electronic market where various securities are traded. Uh, uh, in India, we are trading on National Stock Exchange and Bombay Stock Exchange. So these are the places where the stocks are listed after it is after the IPO is given. The secondary market is they are listed in the exchanges. If you don't know about primary market and secondary market, you can watch my basics of share market video. You will get a clearer understanding. So this is what NSE and BSE. Next, broker. To trade in stocks, an investor needs to have an intermediary to connect to an exchange known as the broker. They do not own any securities but purchase or sell stocks on behalf of investors in exchange for a call commissions. To trade in stocks, we need a broker to be connected to the exchange. So he acts as an intermediary. So if we give, he purchases and sells on behalf of us in exchange for he does our transactions. Whatever we want to buy, he buys, and instead for a service, we are giving him a small commissions. So some commissions might be different, but in case of stocks, every brokers are providing fixed commissions. But in some forex related markets, there are different types of accounts, standard accounts and easy in accounts. Standard accounts may get commissions in terms of spread, whereas easy in accounts provide fixed brokerages, just like normal our Indian brokers do in the share market. They provide easy in. So there are several types broker gets commission, but usually there would be a fixed commissions. And I also suggest you get a broker such as who provides a fixed commission. So it is highly reliable. So next comes the DMAT account. What is a DMAT account? It is the short form of dematerialization account. Dematerialization means in olden days, now we are trading in electronic format, in online, having a computer, we are trading online. It's easier for us. But in olden days, they used to go directly at the exchanges and they trade, and there used to be jobbers. And the jobbers are provided daily salaries, and these involve physical shares, and the share certificate will be provided to you if you buy the shares from the seller. So this takes place. So converting your physical shares and storing in electronic format is dematerialization, and the short form of dematerialization is DMAT account. So what is trading account? You might wonder, DMAT account and trading account is the same. No, they are different. But you know, when you open a DMAT account, you're also opening a trading account along with them. So what is a trading account? It is used to buy and sell shares in the share market. The transaction is you're buying and selling shares actually in the trading account, but you're storing the share in DMAT account. So the trading account acts as the link between your bank account and your DMAT account. When you buy shares, um, your money gets transferred from the bank account. You're transferring the bank from money from bank account and storing your money in the trading account. And after that, if you are purchasing the shares, you're giving the money to the broker, and your shares get transferred into your DMAT account. So this is what happens, and trading account acts as a link between your bank account and DMAT account. So next, what is a bull, bear, and bunny market? Bull market means this is your bull market. Bear market means this is your bear market. Bunny market means it is sideways market. So when it's performs higher high, higher low, higher high, higher low. In this case, it's lower high, lower low, lower high, lower low. So this is uptrend and this is downtrend. So uptrend is known as bull market, downtrend is known as bear market, sideways or range bound market is known as bunny market. So this is you can easily understand what is bull market. You can also see the definition if you want it by passing the video. And next comes the long and short positions. So long position means it's buying position, and short position means you are selling position. So in stock market, you can buy and sell and make profits. You can buy at low price and sell at high price and make profit, or you can sell at high price and buy once the come stocks at low price. You might wonder how I can sell without buying a stock. You are borrowing the shares from your broker and you're selling the stock. So this is known as short selling. I will bring a separate video for short selling, but this is a basic. I will say to you generally what is short selling. So so it refers to the buy order you place and you make profit if stock prices increases above your buying price. It refers to the sell position you place and you make a profit if the stock price decreases below your selling price. And then what is portfolio? Portfolio means, suppose if you are investing in Tata Motor stock, if you are investing in Indian Bank, if you are investing in, you are taking some 2 or 3 automobile stocks and 2 or 3 banking stocks, and overall you are invested in 6 companies, and total those your investments, your collection of investments is known as a portfolio. Then what is a benchmark? A benchmark usually consists of a variety of companies, stocks of the companies. For example, Nifty 50, it's a benchmark. Bank Nifty, it's a benchmark. Nifty Metal, it's a benchmark. Nifty Private Bank, it's a benchmark. Nifty Energy, it's a benchmark. So what is does take for example Nifty 50. So the first 50 top 50 companies, mostly usually the blue chip companies, which in terms of market capitalization is used in the Nifty 50, is there in the Nifty 50. It changes accordingly due to the performance. As the market capitalization changes, the performance of the stocks changes. The Nifty 50 removes some shares and adds some other shares to its benchmark. So this is what the benchmark is. So usually Nifty 50 consists of top 50 companies. If this 50 companies falls, then the Indian economy is falling. So this is what the general representation. If these 50 companies rises, the economy is rises. So this is a general view. So benchmark also known as market index, or collectively it is known as indices. So this is known as benchmark. So yield, what is yield? Yield simply refers to the return on investment. If you are investing in shares and your earnings yield is around 10 percentage, means then that is known as the return on your return on investment is 10 percentage, means then your yield is 10 percentage. For example, if you are investing in bonds or fixed instruments, and it is known as bond yield. Your return on investment, for example, if you are purchasing a bonds from a company and they are providing you interest of 10 percentage, means, or 8 percentage, take it for example, then your yield is 8 percentage. This is what yield. Then volatility refers to the rate at which the stock prices fluctuate in the share market. For example, if the stock fluctuates between 100, 110, then again 100, then 120, then 90. So the volatility is so high. If it goes around 100, 102, 98, 101, 97, so there is not much volatility. So this is a low volatility and this is high volatility. So high volatility means your risk would be high, but your reward would also be, your profits would also be high if you are trading very short term. If the volatility is low, your risk also is less, but your reward also would be less. Your profits also would be less. So after Corona, our Indian stock market become a highly volatile market. But before Corona, our Indian market was at very low volatile. So this is the basic example of volatility. Then next comes the alpha. Alpha is measure of an individual stock performance in relative to the overall market. For example, if our Nifty 50 gives a return of 10 percentage, sorry, if a nifty if a company, for example Tata Motors, it's having an alpha of 1.2, means 1.2, Tata Motors has an alpha of 1.2, means if our market, that is Nifty 50, gives a return of 100 percentage, Tata Motors gives a return of 120 percentage. That is, it giving 20 percentage more returns than our Indian, sorry, overall market, that is Nifty 50 benchmark. If it's 0.8 alpha, means it's giving 80 percentage returns when compared to the market is giving 100 percentage, but Tata Motors is giving only 80 percentage. So these high alpha stocks gives high returns. Usually growth stocks have high alpha, and defensive stocks usually have some low alpha. So mostly beta is calculated in terms of growth and defensive stocks. Even alpha is not used, but still you can take alpha as a reference. So this is the example of alpha. Next comes beta. It measures the volatility of the individual stock when compared to the overall market volatility. So for seeing the beta value, you can visit investing.com. It's usually given, or other websites where the fundamental analysis is given, such as alpha beta. So it is the measure of volatility of individual stock when compared to the overall market. It alpha measures the returns, whereas beta measures the volatility. For example, if a stock has 1.5 volatility, if the market goes 100 percentage, uh, it will the stock which has 1.5 alpha will go 150 points more volatile than the market. That is 150 market of the, sorry, if the market goes 100 percentage, this goes 150 percentage. That means 50 percentage more than the market, that stock has the volatility. So usually growth stocks have high beta and they provide high profits. Also, they, if losses come, your losses would be high. Whereas defensive stocks usually have a lower beta Some might even have zero beta. Zero beta means it is independent of the market. It doesn't consider the market. Market if goes up, the stock might go down. If the market comes down, the stock might go up. It's independent of the market. If the beta is around 0.5 percentage, it is 50 percentage less volatile than the market, which means if the market goes around 10 points, it only goes around 5 points. So this is the denotation of the beta. So this is what alpha and beta means. Next comes the dividend. Dividend means the company, we can make profit in two ways. One is the capital appreciation, that is the normal price increase which happens in the shares. The next thing is dividend. For suppose if the company makes sales and after reducing the expenses, it makes a profit, and the net profit is usually divided to the shareholders. Not all the net profit is divided, only a portion. Some is reinvested into the business for future expansion of the business, and some is rewarded given to the shareholders as dividends. So that is what the dividends is. Next, volume. Volume is the total number of shares traded or transacted during a specific period. You can see in different time frames. In 15 minutes, for this 15 minutes, how many volume you can see. If there is high buying volume, then many shares are bought during this period. If there are high selling volume, then most shares are sold. You can see this volume in terms of breakout. If the shares break out, if the price breakouts, you can also see the volume whether it's breaking out compared to the previous volumes. If it breaks out simultaneously along with the price, you can see that the breakout is more valid, highly reliable, and you can buy the stock. So next, leverage. Leverage means it's using borrowed money for trading. Suppose you are having 50,000 in your DMAT account, but you can buy around, if you are given 5x leverage, you can buy around 2 lakh 50,000 worth of shares you can buy. For that money, you can buy. So with your money, 5 times more you can buy the shares. So margin means it's the minimum amount needed in your trading account to do delivery trading. For example, keep example like this. Keep a formula like this: 100 divided by margin or leverage. Margin or leverage. Take if you want to calculate the leverage. Suppose if you are given 20 percentage margin, your leverage is 5x, 5 times more. Or if you want to calculate the margin and you are given the leverage, for example, if you are given 10x leverage, you can post it as 10 percentage margin. So if you are giving 10 percentage of leverage, you must have at least 10 percentage of the money in your DMAT account. Then only you are eligible for doing leverage trading. Otherwise, you are not. So this is the difference between margin and leverage. So mostly margin and leverage are usually intraday traders and scalpers use this use this leverage trading. Usually delivery based traders don't use this thing. But even for delivery, there is an account known as margin account where some brokers provide leverage trading even for delivery. You can also see that. Then next comes IPO. So there are two types of market. One is primary and secondary market. So IPO is primary market. Before listing in the NSE and BSE, that is secondary market, the shares are first issued by the company to directly to the public. So this is known as IPO. The company uses underwriters to do this IPO process, and you can buy from even from the IPO. So the next is blue chip stocks. Blue chip stocks means these are shares of well-known companies, well-established companies which are making consistent profits and are having a large market capitalization. Usually, they are well-known to all common people who aren't in the share market even know about these companies. So these are known as blue chip stocks. Usually, the Reliance Industries, ICICI Bank, Kotak Mahindra Bank, State Bank of India, so Dr. Reddy's and even Dr. Reddy's many might not know it, but still it's a blue chip company. So well-known companies are known as blue chip stocks. They usually have large market capitalization. Then comes the penny stocks. Penny stocks are shares which trade at very low price and have very low market capitalization. For example, 1 rupees or 2 rupees or 5 rupees, 10 rupees, 20 rupees. So these are known as even 20 rupees. Okay, 20 rupees. So these are known as penny stocks. So these are very highly trading risky stocks, but if they give profits, they would give enormous amount of profits. So you can get a lump sum amount of money at a very short time if they give profit. But if they are low volatile, actually they don't increase in price that much. So they are risky stocks to invest in, but if they give profit, you will give they will give huge returns. but they are also in a risk of bankruptcy. Mostly, usually, many companies which are in bad financial status, they are at a brink of bankruptcy. These companies usually be penny stocks. And if some the management is effective enough to bring the company from the scratch, from the bottom to the top, these penny stocks can be rewarding. So next, the large cap, mid cap, and small cap companies with market capitalization of 20,000 crore or more are known as large cap. 50,000 and less than 20,000 crore are known as mid cap. Companies with less than 50,000 crore are known as small cap. So usually large cap companies, blue chip stocks usually are large cap companies. And mid cap companies means intermediary companies. They don't have that much market capitalization, but still they are good enough. So this is the thing. Next, the companies with market capitalization less, that is market capitalization refers to market value per share into number of outstanding shares. So this is the small cap stocks. The beginners who are trading in share market, usually you trade in blue chip stocks or mid cap stocks. So large cap and mid cap is okay for you, but don't trade in small cap. So trading usually, if you are experienced, if you are trading in share market for around 2 or 3 years or 4 years, then you can choose any stocks. But if you are a beginner, choose mostly blue chip stocks or mid cap stocks and trade. Usually, mostly trade on blue chip stocks. So next is averaging up and averaging down. So averaging up means you're buying shares at various higher prices. For example, if the stock is 100 rupees, you are buying around 25 quantity, and once it reaches 105, you are buying another 25 quantity. 110 rupees, you are buying another 25, and 115 rupees, you are buying another 25 rupees. So your average approximately would be 17.75, and this you are getting around 100 quantities at 17.75. It usually increases your it usually increases your overall buy or sell price. So you have to average up only in case of selling, but for buying you should not average up. So this is my suggestion, because it might lead you to losses. And if only averaging up and down is usually done by traders who are not aware of technical analysis, and you are only buying based upon fundamental analysis, these people mostly do this averaging up, or the investors, long term investors, usually do averaging up. But those who are following technical analysis, they are usually disciplined, and they don't follow this averaging up. They usually buy the lump sum order. They put a lump sum order at some specific points, limit order, and they buy the stock and make profits. So even I don't use this averaging up and down strategy, but this is one of the strategy. And then averaging down. So this is the process of additionally buying shares at various lower prices after placing your initial buy or sell order. This decreases your overall buy and sell price. So take it inversely. If you are buying at 115, 25 rupees, then it decreases to 110, you are buying 25, then 105, you are buying 25, then it decreases to 100, you are buying 25. Then the average is 105, 575. Your initial order is 115, but your final price is around 107.75. It decreases your overall buy or sell price. You can do this averaging up in selling. You can do this averaging down in buying. So you can do in both, but I prefer that you do it on selling in the case of averaging up, and buying you can do averaging down. So this is less riskier. If you do the opposite way, you might lead to it might lead to losses. But mostly, if you are following technical analysis, don't do this averaging up and down completely. Leave this, eliminate, don't do this. Only if you're following totally, I don't like technical analysis, I only follow fundamental analysis, then you can do this strategy, but I suggest not to do it. Then comes the pre-market and post-market. Pre-market means the usually the NSE and BSE market hours is 9:15 to 3:30 p.m. So 9:30 a.m. to p.m. So before 9 o'clock to 9:15, the pre-market occurs. So up till 9:08 p.m. you can place your orders, but after 9:08 you can't place your orders. Once before the 9:08, those all members who have placed orders, their orders get executed, and their trades are matched. And once the market opens, then the trades are executed immediately. Whereas 8 to 8:15, the market only places the orders, sorry, execute and matches the trades, and it does not accept the orders. Only before 9:08 it accepts orders. So next, post market. Post market, it occurs after 3:30 p.m. After market order is different from post market. Many might think after market order is same as post market. If you didn't do not know what is after market, you can watch my types of orders in share market video. So that is different from post market. Post market has different times for maybe NSE and BSE. I haven't done post market trading, but I have traded in pre market. I have placed orders on pre market, so you can refer to the NSE website and see the port market timing. So this is a small trading session that occurs after the actual market orders. So these are the basic share market terminologies that is even if you don't nothing, even you don't know a single word about trading. So these are the basic things that for a beginner. So this video is for a beginner. If you didn't understand what are these terms, you can watch this video. This is helpful for you. So this is only for cash market. For options it is different. So options terminologies, I am not teaching options. Even in my trading session I only teach equity, so technical and fundamental analysis. If you are willing to join my trading class, you can call my number in the scrolling below and I will teach you trading. I'm also providing discounts for the first 25 members. You can join my course if you are interested in. And also, if you want to open a DMAT account, I have given you Zerodha link in my video YouTube videos description. You can open your trading account online and start trading or investing from today onwards. So hope you guys enjoyed this video. If you like this video, like this video, share it with your friends and family, and subscribe to my channel. Also press the bell icon so you get notified for all my educational videos. So I'll visit you on another interesting video such as this, and until then, bye bye, take care.